what are the different things that are available? And big question, when does mortgage insurance come into play?
That is a great question. How do we determine that? Well, FHAs, I'm going to go into FHA first because it's not actually for first-time home buyers. Anyone can use an FHA loan as long as they meet the guidelines. So one of the big differences between a conventional and FHA loan is your credit score. Right now, FHA will allow you to go down to a 600. And you can have higher debt to income ratios. Conventional is more conservative. They're looking for a minimum of a 620, but you're going to see your better pricing and better eligibility once you're above that 640 to 660 range. It really takes a look at the full credit profile, and that's one of the reasons why we use an automated system to help us review and evaluate the whole profile, not just that the income fits to get you qualified. We have to take a look at many other factors. How are you utilizing your credit? Have you had derogatory credit? Maybe you don't have a lot of credit. So there are many things that come into play when we're looking.
So can you tell us, in an FHA loan, for example, what you would have to put down and what the associated costs are that are specific to an FHA loan?
Yes, absolutely. So FHA requires a minimum of 3.5% down payment. They also have an upfront funding fee. So after you put your 3.5% down, FHA then adds on top of that base loan amount a 1.75% upfront funding fee to give you your total loan amount. On top of that, they also have monthly mortgage insurance. So if you're only putting your minimum of 3.5% down, your monthly mortgage premium will be 0.85%, and that's every month for the life of the loan.
So that never goes away. The mortgage insurance component never goes away. If I
Correct.
get an FHA loan, I put 3.5% down. On top of that, there will be a funding fee and a mortgage insurance premium that lasts the life of the loan.
Correct, unless you were to refi down the road into a conventional loan.
Okay.
If you put 5% down on an FHA, upfront funding fee is the same. Your monthly, though, is for only 0.8%, and that stays on the loan for 11 years. So after 11 years, you could have the MI removed, as long as you have 20% equity in the home.
Okay, so at the point in time, if you've put 5% down,
yes,
that once you have 20% equity in the home and been paying on that loan for 11 years, you can ask that the mortgage insurance be removed. Do I have
correct.
that right? Okay.
That
good.
is correct.
Okay. So that tells us a little bit about FHA loans. What about conventional loans? And do conventional loans have mortgage insurance?
Yes. So conventional loans, there's actually quite a few different programs under conventional. But when you put 20% down, you do not have private mortgage insurance. There's no monthly mortgage insurance once you're putting 20% down.
Okay.
Anything less than that will require monthly mortgage insurance. And the coverage that you have depends on the amount of money that you put down. And then the fee associated with that is dependent upon your credit score. So it can vary on every single person that is looking to do conventional less than 20% down. Now, one of the things with conventional is that once you have 20% equity in the home, you can ask the lender to do a review of value. And if that value is 78% or less, they can just remove the MI. You don't have to refinance.
You need to make that request.
Correct.
Okay.
Yes,
It
as the
doesn't
homeowner,
automatically.
it does not automatically. They will just keep collecting it from you until you actually reach out and ask them to do a review.
Okay. Okay.
Now,
So,
anything less than that, if you're not putting 20% down, so conventional will actually start as low as 3% down. If you're a first-time buyer, if you meet income restrictions, there is a home ready and home possible loan with 3% down, but you're at 80% of the median income for your county. If you fall into that parameter, then you can put as little as 3% down. The typical, yeah, go ahead.
so what you're saying is that every loan is very individual to the family or person applying for the loan, and that there are no real blanket qualifications. It's individual to every person.
It is very individual to every person, and that's why I always tell consumers that I know your neighbor may have gotten one program or may have gotten a rate or may have, gotten so much in closing costs. Every single consumer's situation is different, and it is always best to speak to the lender and have the lender review, again, your income, your credit. The assets you're going to use also play a part in the purchase. Do you have your own assets saved? Will you be getting gift funds? All of those have to be reviewed, and then the lender should look at all the options that are there for you depending on what your scenario is. So yes, every consumer situation is different, and it's a hard thing to understand when they're hearing that, their neighbor, their friend got this rate or that. I don't know what played into that situation.